All right, so the other day we were talking a little bit about the depreciation and being able to increase your basis for tax purposes to increase your returns. Now, one of the tactics that we talked about was utilization of a 1031 exchange. It's also good for agents to understand the 1031 exchange because a lot of times somebody doesn't want to sell a property because they don't want to get hit with capital gains, nor do they want to sell a property because they're not sure what to transfer into. So if you can explain and show them that there is a vehicle, a 1031 vehicle, where they can avoid, or I shouldn't say avoid, defer capital gains, then this could help with sales. So essentially, there are some rules with the 1031 exchange that we should be aware of and really should understand that some are, then they are hard and fast rules, meaning you can't bend them by a day or anything else. So that it has to be done this specific way, or it could invalidate the entire 1031 exchange and they would still have to pay capital gains tax. So number one, and this is a term that is very commonly misunderstood, like for like. So a lot of times when people hear like for like, you have to exchange one property for a like property. They immediately go to the simplest explanation of house for a house. Really, the way the IRS looks at it, it's like for like in the sense of real estate for real estate. So meaning you can't sell a piece of real estate and exchange into stocks, but you can sell a piece of real estate and exchange into any other type of real estate. So you can exchange into land, you can exchange, from a house purchase, you can exchange into land, into a commercial property, into a multifamily, into another house, okay? Now, the like for like also means investment. Bless you. So investment property. So it needs to be an investment property for an investment property, meaning you can't sell investment property and then buy a primary residence with your exchange funds. That would invalidate the exchange. So those are the rules when it comes to like for like. Now, another rule is that there needs to be a third party intermediary that's involved in the transaction, and it needs to be set up prior to the close of escrow, not after. So what this third-party intermediary, oftentimes called an accommodator, does is they receipt in all the funds from the sale of the property that they're looking to sell, which is now called a down leg, and they hold those funds until you identify the properties and acquire the property for the up leg. Okay, so, and that's the new property. The up leg would be the new property, the down leg would be the property that you're selling. So it needs to be a qualified intermediary. That could be some escrow companies do this service, some attorneys do this service, as long as they have they're not doing any other legal review for this purchase or the sale of the property. Or there are specialized companies, accommodation companies, that do this as well. So make sure you have a good team. Again, it has to be done prior to escrow. Essentially, in a simplified format, what's happening is that the seller is assigning their interest in that property to the accommodator, who then holds that fund during the time frame. And then when they purchase the property, they assign it back to the seller, who's now the purchaser. So it all has to be done ahead of time. If for some reason you wait and it's not done, you close escrow ahead of time, you can't really do the 1031 exchange. If the buyer receipts, or rather I should say if the seller receipts in any money, from the sale, if they get the money from the sale in and then go to an accommodator and try and transfer the money, it invalidates it. The seller cannot touch any of the money. Any of the money that they do touch, even if it's electronically and just goes straight to the bank and straight to another bank, is now ineligible for a 1031 exchange. Okay, so accommodator needs to be set up ahead of time. And what they will do is, once they receive in the money from the sale of the transaction, you'll have your net proceeds. The accommodator will give you a net proceeds letter saying that they've received in X amount of money. That should be your proof of funds for your up leg when you're going out. If anyone asks, what funds do you have? Well, I have proof of funds from the accommodator showing that they've netted in 2 million, 3 million, 5 million, whatever the amount is. From there, a person doing a 1031 exchange, the next hard and fast rule is 45 days. Okay, so from 45 days to from 45 days to from the sale of their property, they have to identify a replacement property. Okay?
Of the downleg.
For the upleg. For the upleg.
From sale.
From the sale of their
Close of
downleg, from the close of their escrow, they have 45 days to identify an upleg. Now, the identification process is a little unique in that you can identify, there's a 3 rule and a 200% rule. Okay? Now, what the 3 rule is, it states that if you identify 3 properties, regardless of what the sales price is, you can identify 3 properties, and you only have to acquire one of those 3 properties to potentially satisfy your upleg, or you can acquire 2 of them, or you can acquire all 3 of them. So you can identify those properties and then figure out how much is being allocated to each property, or maybe if you're only buying 1 property, you still might identify 3 with 2 as a backup, just in case something goes wrong during the due diligence time frame of the property that you originally identified. Okay, so in that 45-day time frame, you have to identify those properties. The other rule is the 200% rule. Okay, so you can identify as many properties above. You can identify 4, 5, 10 properties, as long as the total value of those properties do not equal more than 200% of what you relinquished. So if you sold a property for $2 million, you can identify 5 properties to replace it, as long as the total value is not more than $4 million. Okay? If it does, you can still go forward with the exchange, but you have to now buy all of the properties. And if you don't buy all of them, it invalidates the entire exchange. So very rarely do we see this, except for maybe some very high sale prices where they have a little bit more leverage with some cash coming in to be able to identify multiple properties from one large relinquished property. So be aware of the identification period. You can identify 3 properties, up to 3 properties, or if you identify more, it has to be less than 200%, or you have to buy all of them. Okay? So that's something, yes.
200% of what?
Of what you sold.
Of what you sold.
So of the relinquished property. So it would have to be, you can identify up to 200% of the relinquished property. Anything, if you go above that, then you have to buy all the properties. Okay? Now, the other deadline or hard and fast date is 180 days. This is 180 days from the sale of the property, not 180 days from when you go into escrow. So you have to still close that property within 180 days. Okay? So from the sale of the property. So what that means is that if you wait till the 45th day, you have the property, you tie it up, really you only have about 135 days left to close escrow. Okay, during that escrow period. So it's a total of 180 days, 45 days to identify, a total of 180 days from the sale of your original property to close escrow on your new property. It's 181 days. Your 1031 exchange is invalid. Okay, these are hard and fast dates and times. Now, the other rule to avoid, or again, to defer 100% of your capital gains, you are looking at identifying, you have to replace not just the purchase price, but also any debt that was in. So essentially you have no money that you're taking out of the transaction. So in that example earlier, we talked about a sale of a $2 million property. If you identify a property and let's say it's an all cash sale that they sold, and they have $2 million rather in the accommodation account. You can identify a property for $2 million or more and pay cash for it, or identify it for $3 million, pay $2 million cash and a $1 million loan, and you're still okay with the exchange. If it's less than that $2 million, then whatever is the difference is what they call boot. Okay? So that means that you're taking back some money, potentially boot. So let's say, because it's not a perfect world. Let's say your basis was 0 on that $2 million property, and you had to, if you didn't do an exchange, you would have to pay roughly $600,000 in federal capital gains tax. Okay? So instead, you find a replacement property and you do an exchange, but it's only for $1.9 million. So you still get the $100,000 back. It doesn't invalidate the entire exchange as long as everything else was done correctly. But you have to pay capital gains on what the difference is, what they call the boot, the $100,000. Okay, that boot can also can come up in other ways as well. For instance, let's say in this scenario we had the $2 million asset that maybe it had a $1 million loan on it. Some people may be thinking that, you know what, I'm going to take $1 million cash that we got out of that asset and I'm going to finance it. And, you know, as long as I don't use the cash, or I'll just buy something for $1 million. Well, if they don't replace the debt, then what ends up happening is you actually owe boot on that. You're taking boot. So if you have a $2 million asset that you sold and there's $1 million loan on it and your net proceeds are about $1 million. If you only identify a property for $1 million and you buy that property, then you're paying capital gains tax on $1 million of the loan or what you didn't replace, the boot. So that's another $300,000 in federal capital gains tax, but you may not have that because you used all that cash to purchase the other property, all cash. So you have to remember to replace the debt, at least the minimum amount of the debt. You can always go bigger. So you can get $1 million and get a $2 million loan and buy something for $3 million, and that's fine with the exchange. Or you can get $1 million and get another $1 million loan and satisfy exactly what the exchange is. Or lastly, you can get $1 million and maybe just an $800,000 loan. You pay the boot on the $200,000 remaining. Ultimately, you have to remember, you just have to, in an exchange, the exchanger has to be replaced, not just the equity, but the debt that they may have had. Okay? So be aware of that, especially if there's any kind of debt that's involved in the transfer of the original property when they sold it. Okay. So lastly, reverse exchanges. You know, sometimes you're going to come up to somebody and say, I don't think, you know, the market's pretty soft, the inventory's pretty low. I don't think there are 45 days is enough time for me to identify a property. What do I do? You know, a couple things. One, you can work it around in the escrow period so that when they sell their property, they can potentially extend it for a couple of periods after the buyer of their down leg removes their contingencies. So this way they can have that room to potentially extend it for maybe 30 days, 2 or 3 times while they look for that property. The other option, and this does require capital, is what's called a reverse 1031 exchange. Okay? And that's where they actually go and before they sell their property, their down leg, they actually buy the up leg first. So they identify a property that they want to acquire. They purchase that property, whether it's all cash or with a loan to match kind of what they're planning on selling. Excuse me. And then the accommodator holds that property in trust until they sell their property and acquire this and then they transfer it back over. So it's a reverse exchange. They don't necessarily own the property right off the bat because it's held into a trust. Now they still will have the income and everything else that's coming in. The accommodator holds on to that. They don't keep it. So it will build potentially into it. But then they then get the opportunity to sell their property. So if they sell their property though, remember, one rule remains there, and that's the 180 days. From the time they acquire the up leg in a reverse exchange, they have 180 days to sell their down leg and close escrow. Not just sell it, but close escrow in 180 days. So timelines, they don't have to identify anything obviously because they've already identified their up leg by purchasing it ahead of time. But now they have the time frame of 180 days. And the 180 days will start from the date they close escrow on their up leg. Okay, so there are definitely some opportunities here with 1031 exchanges if you utilize it with your investors right, to be able to get them to sell, look at properties, exchange, create higher basis for tax returns. That's the beauty of real estate and why investing in real estate can be one of the best ways to become wealthy. Okay, so questions?
A lot.
Huh?
1031 exchanges are just tricky.
They can be tricky, but and 1031 exchanges can be tricky. But if you have the right team behind you that knows what they're doing, and this is something that we talk about all the time, is about team building, who your team is, what vendors should you have, and we'll actually do a class on that as well as for some of the newer agents to build your team, people you can rely on, who you can always go to either ask questions, but also to help you out with the services. So if you have a good team, all the tricky parts kind of fall out. What you as the agent need to remember are essentially the time frames, and you can calendar those, and the rules as far as the replacement for the amount of money. So, just remember, whatever you sell it for, I have to acquire something that's essentially the same price minus the expenses of the sale, and also replace any of the debt that may be there. So,
Where do we find an accommodator?
Quite a few different accommodators. Actually, you can go to our website. We have for I think some of the vendors. If not, you can contact us that way. We have a vendors list as well. So, one of the best accommodators I like to use quite a bit is Exchange Resources. Gentleman named Phil Atwan, very professional, very knowledgeable. In fact, he's probably the one who trained me the most. Actually, we kind of go back and forth a little bit. So, but yeah, so he's, and also remember that your CPAs, your accountants, although they're professionals in the accounting field, they may not have done that many exchanges and may not be as aware of them. So really you want to rely a lot on the accommodator to speak to the CPA, to speak to their accountant and whatnot. So they understand the mechanisms, but they may not have done a lot of them. So just be aware of that as well.